Over here is interest rate swap quotations in Wall Street Journal, and then the table, okay, on your vertical axis is time to maturity, okay, and then what you see on your horizontal axis is different currency unit, okay, and then it shows bid rate and ask rate for swap banks. Basically, the idea is that this interest rate that you see are the fixed interest rate that corresponds to the US dollar LIBOR for respective maturity. Okay? Again, this is the fixed interest payment for respective currency, euro, sterling, or Swiss franc, or US dollars, or Japanese yen, for correspondent maturity that matches the floating rate interest rate. Okay, floating rate interest rate. For example, 1.16 to 1.1 over here, it means that the swap bank will pay fixed rate euro payments at 1.06% against receiving US dollar LIBOR, or it will receive fixed rate euro payments at 1.16% against receiving US dollar LIBOR for 25 years. Okay, so that's how we interpret this table. Quotations, bid-ask spread. Okay, here diagram shows 1.06 to 1.1 means the swap bank will pay fixed rate euro payments at 1.06% against receiving US dollar LIBOR, or it will receive a fixed rate euro payments at 1.16% against paying US dollar LIBOR. So swap bank is the middleman guy over there, right? Firm A, firm B. So what you see on the bottom over here is a fluctuating or floating rate interest payment. Okay, the firm A, okay, they pay the swap bank a US dollar LIBOR, the floating rate interest payment. This swap bank, in exchange for that, they pay this firm 1.06% fixed of euro currency. Okay, for firm B, on the other hand, right, the swap bank pays them US dollar LIBOR floating rate. Okay, in exchange, they receive 1.1% euro. Okay, from company B. Okay, that's basically it as a middleman. Of course, without swap bank, firm A and B could directly transact with each other, right? If they know well, and they can talk to each other directly without the involvement of any middleman, right? But if they are small guys, right, small banks, the swap banks will help them. Okay. Now, while most swaps were quoted against the flat dollar LIBOR, flat means LIBOR plus 0%, flat, okay? Flat LIBOR. Off-market swaps are available where one party pays LIBOR plus or minus some number. So LIBOR plus and minus based can also happen, but this is the market convention. Now, fixed for floating interest rate swap, let me bring a textbook example over here. I place some real names of the banks and companies involved just for the purpose of our fun. Okay, fixed for floating interest rate swap example. Well, let's think about HSBC, a bank, right? Here's a bank, the HSBC. Its credit rating is AAA in the UK, and it needs to raise $10 million to finance its floating rate euro-dollar term loans to its corporate client Rolls-Royce. So if you look at HSBC's balance sheet, okay, here's an asset, here's a liability or debt, okay. The thing is, the HSBC already has a corporate client, Rolls-Royce, okay, and then they lent some money, okay, term loans, and a floating rate, FRN, the wiggle over here, okay, shows you in the floating rate interest rate, okay. So that's your asset side of the business for HSBC, okay. HSBC loan is their asset, okay. The thing is, the value of this loan is exposed to floating interest rate, okay. Of course, getting back to the idea of interest rate risk, FRN, the interest rate risk is minimal, right? Minimal because it moves together with the interest rate, okay? But the concern is about the liability side for HSBC, okay? A floating rate loan, if you have it, well, you have a choice to meet this asset with different kinds of liabilities. One is to meet this with the floating rate liabilities. The other is meeting with fixed rate liabilities, okay? So the first bullet point says that HSBC wants to raise capital to finance this loan, okay? Through fluctuating loan market, okay? Alternatively, this HSBC could issue same maturity fixed rate euro dollar bonds at 10% over here, okay? But if this happens, what is the concern? Well, bank balance sheet, we call it asset liability management, ALM, right? Asset liability management. Well, floating debt should be matched with floating assets to manage your interest rate risk, okay? You want to go with the flow, okay, on both sides of the balance sheet, instead of one guy fixed and the other guy's moving, and then you're going to be troubled like this, okay? So that's basic idea. Or should I say it this way, or yeah, like that, right? If this happens, right, depending on the interest rate, your buffer capital will be hurt very much, so that you want to avoid that kind of situation, okay? If one is floating and you want to make it floating on the other side, okay, that's the idea for HSBC. So they want it floating right now. Now the next page, okay, next page, Starbucks, right? Why do I have Starbucks? Because I drank coffee, okay, to better prepare for your class note and discussion, right? Starbucks is credit rating BBB, let's say. I don't know, okay, it may be different, but let's say this is BBB, a US company, and this guy needs $10 million, exactly the same amount, to finance its capex with a 5-year economic life, okay? It can issue a 5-year fixed rate bond at 11.25% in the US bond market, okay? Alternatively, it can issue 5-year floating rate note at LIBOR plus 50 basis points. Okay. Assumption that interest rate is anticipated to rise in the future, okay? For Starbucks, they want to lock in to the low fixed interest rate, hopefully somehow, okay? So fixed rate debt would be optimal for Starbucks at this situation. Now, one interesting thing is this, okay? There is something called quality spread differential, or QSD in short, okay? The key to swap is that a QSD exists, okay? QSD is defined as the differential of floating rate interest rate and the differential in fixed interest rate, okay, between two different companies or two different entities, right? Rate differential in floating rate and rate differential in fixed interest market. So differentials minus differential. It's like a difference in difference, okay? Difference in difference. you're gonna see it. So here's the table. You see Starbucks and HSBC, and then what you see on the far right hand side is the the differential, which is this guy minus that guy. Okay, Starbucks minus HSBC. That's delta differential. Okay, what we mean by that. And then fixed rate regime and floating rate regime. We have differential in respective market, debt market. Okay, fixed rate differential, floating rate differential. Starbucks fixed rate, they borrow at 11.25%, whereas HSBC, they borrow at 10%. So the differential is 1.25 percentage point. When it goes to floating rate, okay, floating rate, do they have the same differential of 1.25%? That's not the case sometimes, right? Starbucks, they can borrow at LIBOR plus 50 basis points, whereas HSBC, they can borrow at LIBOR directly. They're member banks of British Bankers Association anyway. Now, so that makes sense. But the Starbucks, here's an interesting part. Starbucks, only 50 basis points higher over here. So it's not exactly offsetting this guy. So when you take the difference in difference, this guy minus that guy, you get 75 basis points of QSD, quality spread differentials. Okay, there is a room for profit taking. Oh my God. Okay. So here's the situational diagram. Okay, about the case that I told you. On your left hand side, you see HSBC. Okay, it can borrow at LIBOR flat rate in a floating rate debt market. On your right hand side, okay, you see Starbucks, right? The company can borrow by issuing euro dollar bond 11.25% fixed rate. Okay. By the way, you see SKKU Finance MBA over here. Do you like it? Yeah. All right. So in this kind of situation, you see one more things, which is, do they have, right, HSBC and Starbucks, do they have some alternative debt market they can go and borrow? And yeah, and HSBC, we find that it can issue euro dollar bond 10% fixed, and Starbucks as well. They can issue floating rate notes at LIBOR plus 50 basis points only. And that tells us that there is a huge room, like 75 basis points of QSD, quality spread differential, okay? Which means they can save the borrowing cost if they talk to each other and then do some contracts, okay? For example, let me shrink down. All right, okay. For example, if HSBC can talk to the CFO of Starbucks, hey, we can, mutually benefit by, going to your alternative capital market and my alternative capital market, okay? So why don't I go to euro dollar bond market? I can borrow at 10%. You can borrow at 11.25%. No, stop there, man. I'll borrow it, okay? And instead, Starbucks, Mr., right, or Miss, you go to LIBOR market over there in the floating rate note. You can borrow at LIBOR plus 50 basis points, okay, which is a lot smaller difference than in the euro dollar bond market. Why don't you go there instead of me and borrow over there, and then we swap our the borrowing relations, right? So I give you LIBOR interest, which is fluctuating interest payment over a different point of time, right? Every 6 months maybe, okay? Instead, you give me a fixed interest payment that I have to pay to this euro dollar bond market, okay? Once again, right? Instead of HSBC, the Starbucks going to this FRN market, they will have to pay the floating interest payment periodically. But HSBC would pay for that, okay, as much as LIBOR amount is concerned. plus 50 basis points, well, you take care of it, Mr. Starbucks. I'm going to take care until a LIBOR rate, because that's what I could pay in my LIBOR market. Okay. As an exchange, right? I need to pay 10% in euro dollar bond market fixed. So why don't you pay me, okay, a certain amount more than 10%, okay, more than 10%, because you are saving some cost over there, right? But otherwise you should have gone to the euro dollar bond market and should have spent 11.25%. So you have saved the cost, a part of it. Why don't you give it to me, okay? And we share the benefit of each other. So they can make this kind of contract, swap contract by themselves, right? And the fixed interest rate that the Starbucks should pay in this case could be any rate between 10% and 10.75%, okay? How do you know any fixed rate between 10 and the 10.75% would serve? Well, Starbucks, let's look at it. The cost of funding that is smaller than 11.25% will make me happy, Starbucks CFO would say like that. So LIBOR plus 50 basis points minus LIBOR. That means LIBOR plus 50 basis points, they're paying it, right? But they're receiving LIBOR from HSBC. That's the first two lines. And then the mysterious fixed interest rate, I'm going to call it RX, R sub X, right? This guy, I say, this, R sub X, okay? R sub X. How does that work? Well, that is going to be the amount this Starbucks has to pay, right? So notice the Starbucks has to pay two interest, which is LIBOR plus 50 basis points going down, and then fixed RX rate to HSBC. But it receives LIBOR fluctuating amount from HSBC. Okay, so that's why we have minus LIBOR over here, so it cancels each other. And then what you have are X and 50 basis points. So as long as this guy is smaller than 11.25%, Starbucks CFO would be happy. Okay, that means the mysterious RX should be smaller than 10.75%. Now, HSBC, that's not the full story. HSBC's banker also has to be happy, right? What should be the condition? As long as the cost of funding is smaller than LIBOR rate for them, they would be happy, okay? So cost of funding, okay, previously it was just a LIBOR, but right now, if you look at the diagram, what do you see? Going back over here, right? Instead of LIBOR payment, they go to what? Pay 10% fixed at euro dollar bond market. That's this guy, okay? The first line. And then they still pay LIBOR to Starbucks over here, right? You see LIBOR fluctuating payment. All the floating rate payment, I show it with some wiggled arrow, okay? Yeah, so that's that. And then that's not the end. HSBC will receive RX percent, okay, from Starbucks, because this is a swap contract they're gonna go, okay? So minus RX would be their interest income, right? So net, what would be the cost of funding for HSBC? You sum these three items, that will be minus RX plus LIBOR plus 10%. And then, as long as this cost of funding is smaller than LIBOR, the HSBC banker would be happy. Make sense? So solve for RX, right? RX, send it to the other side of the equation, the inequality. You get LIBOR and LIBOR canceling each other out, and then 10% remains on the left-hand side. So that's RX being bigger than 10%. That gives me the range of RX where the swap contract of the two guys can take place, 10% to 10.75%. Okay. So that's one way of finding out the range, okay, where this guy could end up, right? Where do they end up? Well, it depends on, you know, their negotiating bargaining power, and then their credit ratings. All these kind of things will work, right? But as long as it is determined within this range, both party would be happy, okay? So that's basically the idea. For example, let's say they ended up at 10.5% fixed, okay? So every period, the Starbucks, they would pay 10.5% fixed interest to HSBC. That's better than paying 11.25% fixed to Euro-dollar bond market, okay? They raise the same amount of capital, right? So that's basically the idea. Now, this is direct swap, but usually these two parties, right, don't know each other much, right? Instead, there would be a swap bank that connects these two guys, two friends. Hey, you guys, come on over here, okay? Shake hands, okay? Say hi to each other, right? And make some swap transaction contract, okay? I'll be the one who is connecting you, but not for free, not for free. I have my family to feed, right? So pay me the bid-ask spread, the fees, right? Transaction fees, right? So to Starbucks, they would say you pay 10.5%, but HSBC, you get only 10.375%. The difference is my income as a Societe Generale. I bring it over here, okay? This swap bank, which originally started at in France, right? Anyway, and then HSBC, they pay LIBOR interest amount every period, and that passes through, okay, passes through Societe Generale, and it goes to Starbucks, right? And that's what we mean by pass through, right? Goes through, and then the fees are already paid over here, so they don't double count it, right? That's the idea. Now the table below over here summarizes this situation, right? HSBC, and then the swap bank, Societe Generale, and then Starbucks. Three parties are over here, and then what they pay and what they receive, okay, is shown over here. HSBC, they pay LIBOR amount, okay, LIBOR amount, and then 10% over here to the Euro-dollar bond market, and then they receive 10.38%. Okay, they receive 10.375% actually, right? So this is a rounding error. Don't worry. Okay, it's still there, right? Now, Starbucks, right? They pay 10.5% over here, and then they receive, they pay LIBOR plus 50 basis points. 50 basis points, that's this guy, right? And then that's their payment. How much do they receive? LIBOR interest amount, okay, LIBOR rate, okay? Minus over here means that you're receiving it, okay, because we want to focus on the payment side, right? So what's the net payment for Starbucks? Only 11%. How about HSBC? LIBOR minus 0.375%, or LIBOR minus 37.5 basis points. Okay? Good. So LIBOR minus. Can it happen? Yes, it happens. Again, is LIBOR a risk-free rate? The answer is no. No. Okay, it's not risk-free rate in the first place. Minus spread, okay, is over here. Wow, that's good. And then the swap bank, okay, they pay, okay, this is all about the passing through this swap bank, but on the way some amount will remain in the swap bank. So it pays 10.375%, okay, by being a middleman, but they are receiving 10.5% from the other party. So the difference will be the amount that this guy will take. And it also pays LIBOR amount to Starbucks and receive LIBOR from HSBC. So these guys cancel each other out. Make sense? So minus 0.125% net payment of Societe Generale. That means their income, right, will be 0.2125%. 0.125%. Okay, good. That's basically it for interest rate swap structure. Okay. Right. The next one is about currency swap. We talked about currency swap in chapter 6 or something. So this one is going to be talking more in detail. Now the textbook says about company A, company B, but to make it more fun, I bring some real world company names. So let's say Texas Instrument over here, AA rated company. Why Texas Instrument? The calculator, financial calculator for CFA exams, right? Comes from Texas Instrument. A big IT corporation, MNC, US based ones, and then it wants to finance capex of its German subsidiary, perhaps in Frankfurt, because Frankfurt is finance capital of Europe, and they must need a lot of this calculator for their CFAs, right? They need 40 million euros 5-year horizon, and FX rate is $1.3 per euro. Now Texas Instrument headquarter could borrow 52 million US dollars at 8% fixed rate in US capital market and convert this into euro, 40 million, right? And to pay its German subsidiary. What's the problem over there? Well, what if the US dollar value appreciates drastically over a 5-year horizon? Then the German subsidiary company may come back and say, oh, parent company, I cannot repay you this 52 million US dollars later, okay? That's one risk, right? FX risk. Now, alternatively, the Texas Instrument, right, could tell this guy, the Sun company or the subsidiary in Germany, hey, you go there in Frankfurt market and issue bond over there yourself independently, okay, 40 million euro, and then there they would say what? Interest rate 7% in that European capital market. That's this diagram over here, right? So what you see as a blue curve over here is not a river, but this is Atlantic Ocean. The Atlantic Ocean, the narrowest one ever seen, right? In the diagrams, I guess, at least in my whole life. This is splitting those two countries, which is US and then Germany, right? The country balls are there, right? The FX rate, 1.3 US dollars per euro, okay? Texas Instrument, US company, AA rated, and its German subsidiary, right? The last bullet point that I told you is this solid line over here. Oh, you Sun company, well, you're grown up enough. Why don't you borrow in the euro market yourself at 7% rate? Why 7% rate? Well, the local government, the local capital market will determine it. But the trouble is this. The trouble is, right, this German capital market, okay, those investors in Germany may say what? Was ist das? Huh? Was ist das? What is that? TI, I don't know that. Okay, just like Jahangir, right? We don't know Jahangir. We don't know Texas Instrument. Okay, you may be popular in your home country or the other side of the globe, but I don't know you. Do you know me, right? Do you know Sai, right? This kind of situation, so that they will charge higher interest rate. Your borrowing cost may be unduly high. Okay, that's one problem. Okay. Alternatively, the Texas Instrument, the mother company or the parent company, could raise capital in their home ground, U.S. capital market, borrow it at 8% rate. Okay. Now, luckily, there comes Porsche. Okay, a German AA rated company, right? Let's say, okay, we are just imposing it, assuming it. Let's assume AA rated, similar credit rating as this guy, assuming it. And then it has a mirror image financing needs, which means Porsche America, okay, needs 52 million US dollars for their capex. They need to sell cars over there, right? Rich people may want to drive Porsche. And then for 5 years capex, right? And Porsche could raise 40 million euros at 6% fixed in German bond market, okay? And then convert this into 52 million US dollars and send it to their US subsidiary. That's one solution, but what's the problem over there? What could be a downside risk? What if US dollar value depreciates like crazy? But if that happens, the US subsidiary of Porsche would say, oh, parent company, Vater, mein Vater, I cannot repay your debt, okay, at the end of 5 years, right? Mein Vater, I cannot repay this. Ich kann es nicht, right? That could be a trouble, right? FX risk. Always international financial management, the FX risk is a big issue. Porsche America could issue alternatively, issue Yankee bond in the US market. The parent company could always say, you are grown up enough. Why don't you borrow there directly with your own credit over there? It's AA rated anyway. Our family is AA rated anyway. So why don't you raise capital over there? 9% rate, the local market says, right? Again, mirror image problem happens in the US market. Porsche, right? Porsche America. But the US capital market guys, the investors may say, what is Porsche? They're German guy, but they're not American. I don't know. Okay, so they may charge a higher rate than their what they deserve. Okay, of course, this Porsche example may be a bit overstretched because who doesn't know Porsche, right, in the whole world? But let's say it. Okay, maybe some other smaller German companies. You can think about it that way. So my argument is that both Texas Instruments and Porsche may share same concerns, okay, mirror image problems, right? So what could be done? Well, what could be done? Both companies, right, they have their comparative advantage to issue bond in their respective home ground market. For Texas Instruments in the US capital market, for Porsche in German capital market. Okay, so why don't they utilize this and then reduce their borrowing cost, right? Cost of capital. So one thing they could do is this: if the CFOs of Texas Instruments and the CFOs of Porsche, they know each other and they are good about their common ideas, they may talk to each other like this, right? Let's not bother our subsidiary companies, right? Subsidiary companies, but the parent companies, let's raise capital in the respective home ground capital market and then swap it, okay? That's the idea over here, okay? So Herr CFO of Porsche, or Frau Porsche, the CFO, please, right? Why don't you raise capital in German capital market at 6% rate, and then swap it, okay? So and then we will, okay, Texas Instruments, we will raise capital in the U.S. capital market at 8% rate, the same amount that you need, $52 million, right? You 40 million euros, right? We swap it so that the 40 million euro will go to Texas Instruments and $52 million will go to America Porsche, okay? And then the respective subsidiaries will take care of that interest payment. So for Texas Instruments case, their German subsidiary will repay 6% of interest, okay? 6% of interest for 40 million euros, which is 2.4 million euro every year, and they will pay to Texas Instrument parent company, and then this will pass through the parent company and reach Porsche headquarter, parent company over there, 6% rate. Just pass through, and then that will repay. That will enable the Porsches to repay the German capital market debt, 6% rate. Okay. In contrast, in Porsche America, right? Why don't you periodically pay 8% of interest upon 52 million US dollars, which is 4.16 million US dollars every year, to your Porsche parent company, and that passes through this parent and goes to Texas Instrument, right? Because they raised capital at 8% rate, your payment will essentially pay this guy's US capital market obligation, 8% rate. Okay, so that's basically the structure of it. Okay, they are swapping this interest payment. Okay, all they need, their principal amount, they can convert it into this their respective subsidiaries on their own. But what is important is the interest payment swap. Okay, interest payment swap. Of course, there, the CFOs are busy doing their own internal organizational work, and then they have to worry about the internal politics in their organization and companies. They may not have good information about their other corporations in need of similar capital expenditures. So there comes the swap bank, who is well informed about the capital raising needs of different corporations. So, for example, Societe Generale can get in over there as a swap bank and say, what? Hey, Porsche, I know you have some capital needs for your US subsidiary. And then, hey, Texas Instrument, I know that you have some capital needs for your German subsidiary, and it turns out you guys have similar mirror image capital needs. Why don't you meet each other through me and then do the swap transactions, right, like that, okay? But pay me some fees out of it, okay? So that payment of fees, we'll talk about it a few slides later. But let's ignore that part for now. And then it says, 6% payment of euro interest passes through, and then 8% of dollars interest payment passes through the headquarter companies, and then the bank, and then goes to the respective capital market. It works like this. Now, periodically, you can think about contractual FX rate at the end of each period, okay? Contractual FX rate. What is the implicit FX rate that both parties are agreeing upon when they do this kind of swap transactions? Each period by period before maturity, okay, the contractual FX rate would be like this: $1.7334 per euro. How do we calculate that? Well, this is based on this dollar interest payment obligation, $4.16 million, and divided by the euro interest payment, 2.4 million euros. And if you do the math, you will be able to figure out this rate, okay? And that's period by period interest payment. How about the principal payment at the end of the maturity? Of course, at the end of the maturity, not only the principal, but also the interest will be paid. So, all in all, the contractual FX rate would be 52 million US dollars, the principal, plus the interest payment of $4.16 million, divided by the euro repayment, 40 million euros, plus 2.4 million euro interest payment. Okay, so the ratio between these two, 1.3245 dollars per euro. That's the FX rate. Those guys are locking in. Okay, lock in the FX rate by going through this swap transactions. So that's one thing you should notice. Okay. And then, as I said before, of course, the swap bank, okay, they're not voluntary workers, right? They're the bankers, right? They have to charge fees. Of course, they have to make money for their family, right? So the swap bank would charge some bid-ask spread. So while the Texas Instruments would get 8% interest for their US dollar borrowing from the swap bank, um, the swap bank would charge 8.15%, a slightly higher interest rate, to Porsche, so that the 15 basis points will go into the swap bank's pocket. And then looking at the other side, well, the swap bank would pay 6% of euro borrowings from the Porsche, for the Porsche, but they will get 6.1% interest from Texas Instrument. Okay, so the 10 basis points would be going into the pocket of Societe Generale, okay, the swap bank over here. Okay, so that's how the basic structure works. Now, the variations of basic currency and interest rate swap. Well, a lot of swaps that we learned in this semester, right? Credit default swap was there, right? Debt for equity swap was there. And then interest rate swap is here. Currency swap is here, okay? Focusing on this currency swap, we talked about fixed for fixed currency swap in this Texas Instrument versus Porsche, okay? The borrowing was assumed to be fixed for fixed, okay? And then you can also think about fixed for floating. One side of the borrowing may be LIBOR based, LIBOR plus X%, right? Also, it could be floating for floating. LIBOR plus X% versus SIBOR plus Y%, right? SIBOR, Singapore, TIBOR, Tokyo, HIBOR, Hong Kong, kind of things. Or US Treasury plus Z%, right? All floating rate borrowings, you can think about it, floating for floating exchange. Amortizing based, right? Here, in our example, we never thought about this amortizing based, but amortization means like your principal gets reduced over time, okay? Instead of repaying the principal amount whole 100% at the end, right? You want to repay, okay, starting from the first interest payment, or right, you can structure your debt repayment schedule, okay? Amortization could be there, okay? And then you can swap it. And then interest rate swaps, well, if you think about one single currency, right, and then interest rate swaps, you can think about for floating, okay? Zero for floating. Zero means like zero coupon bond. There, your coupon payment is zero, okay? It's a fixed interest payment that is zero, right? And then for floating, yeah, LIBOR plus something or whatever. And floating for floating, interest rate swap, yeah, you could do it that way. For a swap to be possible, QSD must be, there, okay? Must exist or big enough to justify your transaction cost, right? Quality spread differentials, right? Difference in difference, you remember that. And beyond that, right, creativity is the only limit, right? Sky is the limit, or creativity is the limit. And this is why your marketing brains can thrive. Marketing brains can make a lot of money in finance world. And this is why accounting guys have such a hard time in finance, right? So think about this. Now, risk of interest rate and currency swap. Well, there are a handful of risk elements that you have to think about in swap transactions. First thing is interest rate swap. Interest rates might move against the swap bank after it has only gotten half of swap in the books, or if it has an unhedged position, right? Always the banks try to make a hedge against their positions they created. 반대 position in Korean terminology. They try to create this kind of opposite position to hedge their risk. Interest rate risk. Once you lock in some certain things, what if the interest rate changes and then you becomes disadvantageous to you? Basis risk is the next thing. It's about basis risk may occur if the floating rate of the two counterparties are not pegged to the same index. So one part is LIBOR plus X%, the other side of the swap is SIBOR plus Y%. These basis rate is different, and then the purely coming from this kind of different basis rate. That's called the basis risk. Okay, exchange rate risk. Well, this is international finance, so exchange rate risk is always there. In the example of currency swap given earlier, the swap bank would be worse off if the pound or a certain currency appreciates, right? In the US dollar, I told you before, typo, I'm sorry. The next one is credit risk. This is the major risk faced by swap dealer. The risk that a counterparty will default on its end of the swap. Okay, credit risk. What if Texas Instrument goes bankrupt or Porsche goes bankrupt? Porsche going bankrupt? Is that possible? Unimaginable thing. Okay, mismatch risk. It is hard to find a counterparty that wants to borrow the right amount of money for the right amount of time. Okay, 6 month maturity versus 3 months maturity maturity mismatch, or 6 year versus 1 year, right? Mismatch. That's a problem. And in sovereign risk, it has to do with the political risk, right? The risk that a country will impose exchange rate restrictions that will interfere with performance of the swap. So all of a sudden, maybe your leader, okay, of you're dealing with North Korea. Oh my God, Kim Jong-un comes to you, says no exchange, right? That kind of things, right? What if your dictator shuts down all these exchanges, or they switch from free exchange movement to fixed exchange rate regime? You're basically screwed. So that's the handful of risks that we want to worry about. And valuation of an existing swap. Okay, you can value the swap transaction. Okay, how much is it worth, right? A swap is a derivative security, so valuation can be done with reference to the value of the underlying asset. Okay, how to value a swap? Well, any swap value is the difference in the present values of the payment streams that are incoming and outgoing. Always the valuation is what? DCF, discounted cash flow. Okay, swap, holy swap. How to value this one? But take a deep breath. Okay, it's all about the cash flow and risk, right? So think about what's the cash flow. The swap, we have two directions, opposite directions. Something will be positive, or something will be positive, something will be negative. Net, yeah, you will have net cash flow, right? Somehow. Of course, before that, positive cash flow direction, they will have their own discount rate. You get the present value of it. Negative direction cash flow, they will have their own discount rate, present value of it. Two present values, net, and the net value of this present value will be the value of your swap. Okay, so we're going to see two examples. Okay, any swap's value is the difference in the present values of the payment streams that are incoming and outgoing. Plain vanilla fixed or floating swaps can get valued just like a pair of bonds. Currency swaps get valued just like two nests of currency forward contracts. Now, a currency swap has a remaining life. In this, is an example. 18 months of remaining life. 18 months remaining life. Or you can say it remaining life as tenor, something called TENOR, tenor. It's related to time to maturity, like remaining life, tenor. That's a basic banking terminology. I should write it down over here, I guess. Tenor. Yeah, tenor. No soprano, no bass, right? Tenor. I don't know why they call it tenor. So 18 months, it involves exchanging interest at 14% on 20 million pound for interest at 10% on 30 million US dollars once a year. Okay, once a year. 18 months. So 18 months gets a payment, and then 12 once a year. So 12 months minus. That's 6 months from now. Okay, cash flow happens 2 times: 6 months and 18 months. Okay. All right. Then the term structure of interest rates. You remember the yield curve? The term structure, the shape of this yield curve is flat currently in both the US and UK. And then if the swap market, swap war negotiated today, the interest rates exchange would be 8% for US dollar and 11% for pound. All rates were quoted with annual compounding. Okay, annual compounding. The current exchange rate is $1.65 per pound. What is the value of the swap in US dollars to the party paying the dollars? Of course, the 2 different currencies, right? The problem says let's measure it in terms of US dollars in the end. Okay, fine. So the time horizon, always make it your habit to draw a timeline starting from today, time 0 up until the end, right? The tenor, 18 months tenor, and 6 months and 18 months because annual payment, right? 2.8 pound each time point, 2.8 million pound, and then that's cash inflow. Cash outflow is 3 million US dollars, right? This is a swap transaction. Okay. Notice there is no principal involved over here. This is interest only swap. The value of the swap to the party paying dollars, right, will be like this: 2.8 pounds, right? 2.8 pounds discounted at 11% discount rate, which is 11% for pound interest rate over here, right? Pound interest rate. That should be our discount rate for pound cash flow. Okay, and then once you get the present value of pound value cash flows, convert it into US dollars because we want to measure it at US dollar. 8.33 million US dollars. That's the answer. How about the other direction cash flow? That's 3 million US dollars going out at discounted at 8% rate. Okay. Also, what's the exponents over here? You may question. Half. Raise it to the power of half, and raise it to the power of 1.5. That's this, half a year, and then 1.5 years. That's why. Okay, raising it to the power of those fractional numbers. Okay, that if you want to do the math, then you will be able to figure out the US dollar denominated present value of this outgoing cash flow. Netting it out from the incoming cash flow, you will get the net cash flow present value, 2.775 million US dollars, right? That's the value of this swap transaction. So here is our second example of swap valuation. Now find the dollar value today to the party paying dollars of a 7-year-old swap with 3 years remaining maturity, which is 3-year tenor, right? The swap calls for exchanging interest only on 10 million euro at 5%, for $15 million at 3%. So this is coupon rate, right? Semi-annual payments, and the last payment was yesterday. So coupon rate 5% per year, but that's every 6 months. That has to be 2.5%, and 3% coupon for US dollars, but that's semi-annual. That has to be 1.5% of it. So let's take a notice of it. And then today's exchange, semi-annual payments, and the last payment was yesterday. So every 6 months it will be compounded, right? 3 years tenor, how many periods do we have? 6 months, 6 periods, right? And then today's exchange rate, $1.3 per euro, and the AAA rate, essentially the discount rate that you have to use for this, okay, for the semi-annual period, right? Periodic discount rate has to be 2% in the US, 2.5% in Eurozone. Okay, so that's good. Now the cash flow, okay, two cash flows, long short positions, right? So long euro denominated bond, and the short dollar denominated bond. That's what the swap is about. So first, estimate or calculate the present value of long position euro bond, the interest amount only, because this is not involving principal but interest only swap. Okay, so what's the present value of those interest in euro bond, ignoring those principal? The number of period, okay, over here we are using the financial calculator. Let me expand this, right? The screen over here, Texas Instrument, our good old friend. Hello, yes. Now, some of you may question, can I use this in our exam? Of course. Were you trying to think of your brain only and your hand only? No way. All right. The exam is open book, open note, open everything except your neighbors or your friends' work. Okay. So you can use Excel, you can use this guy or engineering calculator, whatever, right? It's up to you. Now this financial function, okay, just a reminder, right? Number of periods, right? We have to clear everything. Second, time value of money, right? And then number of periods, 6 periods, okay? And then discount rate 2.5%, right? For Eurozone, you said 2.5%. And then don't punch present value because that's what we want to compute. So save it for the last. And payment 250,000, okay? How do you calculate that? Your principal amount 10 million times the interest annual 5% divided by 2 because this is semi-annual coupon. All right, payment like this. And then future value, what's the principal? 0. 0, right? Because the swap is not involving the principal. It's only about the interest swap. Okay, so that's why it's just notional principal. Don't get in there, right? Now the only unknown will be your present value over here. You see it. So what do? Punch the compute. Is that right? CPT and present value. Get it like this, right? So that will be the number that you see in your screen, right? That's not the end. That's euro, and so make sure you multiply it by the exchange rate, which is 1.3, right? 1.79 million US dollars. One thing to be careful about is the sign over here in your calculator. That's minus, but ignore it. Punch plus minus one more time, so that it will be plus number. Okay. mechanically the designers, engineers designed it this way so that you punch in the positive payment amount and future value amount, then the present value will be the opposite sign, right? Opposite sign. Just don't get confused. The second part of the cash flow is a short position, a dollar denominated bond, only the interest part of it. And then how many periods do we have? 6 periods. Okay, 3 years divided by every 6 months, right? So it's like 6 periods. And periodic interest rate 2% for AAA rated in US dollar regime, right? And then don't touch on the present value, but the payment should be 225, which is your $15 million, times 3% coupon rate divided by 2, okay, because this is your semi-annual coupon bond, right? Make sense? Good. Now, that should be your payment, and then the future value should be 0 over here, right? And then what do? Compute the present value of this guy, okay? That should be 1.26 million US dollars, right? Negative cash flow. So net, right? The swap value will be 529,819 US dollars worth, right? So that's how we estimate or compute the value of swap. Now, the next is about the market efficiency in swap market. Is the swap market efficient? Is a question worth asking yourself, right? Some of you may wonder, right? Yeah, it seems like the same AA rated companies having 2 different interest rate in Europe market and 2 different the interest rate in US market, okay? Isn't that market inefficiency somehow? All right. If that is market inefficiency, what should happen? Well, as people take more swap transactions, and all these kind of discrepancies will shrink down and disappear over time, so much so that your swap market size will go down, right? So if those QSD kind of things, quality spread differentials, all these kind of things is purely because of market inefficiency, the swap market will eventually disappear, right? But that's not the case. As it turns out, the swap market size is growing even bigger and bigger, right? So that tells us that it's not the market inefficiency or efficiency that is driving the swap market, but it's rather market incompleteness that is driving the swap market. And that is why the swap market in the world has been growing very, very fast, at least until 2014 or something, right? Or 2012 or something, right? Incomplete information market, I told you about it. Only a limited number of companies are known, right? Jahangir, it gets back to the Jahangir and Sai kind of things, right? In certain part of the world, this company is well known, but other part of the world they are not. Some segment of the market, certain companies well known, but other segments, okay, the company is not, okay, known. So this incompleteness of the market is a problem over here. And then the swap market is eliminating those incompleteness and making this market more complete, right? So that is a usefulness of this swap market. That's the whole story of it. Yeah, if you read this one, it's self-evident over there. 2 primary reasons for to use currency swap is 1, to obtain debt financing in swapped currency at an interest cost reduction, brought about through comparative advantages each counterparty has in its national capital market to hedge long-run exchange rate risk. Those are two purposes. Two primary reasons to use interest rate swap is to, one, better match the maturities of assets and liabilities. It has to do with ALM, asset liability management. Number two is to obtain a cost savings via quality spread differentials, right? By the way, ALM, all these kind of things has to do with your risk management, right? You must have realized that a lot of our discussions have been overlapping with financial risk management class. Yeah. We are just bringing it in international sense. So, and then in an efficient capital market without barriers, this is what I already told you. Swaps offer market completeness, and that has accounted for their existence and growth. It's derivatives market, right? And the usefulness of this derivatives market is about price discovery, okay, plus making the market more complete, right? Swaps assist in tailoring financings to the type desired by a particular borrower. Since not all types of debt instruments are available to all types of borrowers, both counterparties can benefit through financing that is more suitable for their assets maturity structures, right? Well, you may wonder, if all these kind of guys are working to make more market more complete, then eventually wouldn't the opportunities for swap transactors or swap banks disappear? And my answer is not really, because there are so many different companies, thousands or millions of different companies in the world, right? And their debt structure, bazillion different debt structures are there, right? And then there's no guarantee that they are matching with each other, okay? Porsche, Texas Instrument kind of things may happen, okay, across millions of different companies. Think about the possible combinations that you think about. Infinite opportunities are there for you, right? So that's why people make money. The summary part, go ahead and read it. So this is the end of the chapter 14. Thank you for watching and see you. Bye-bye.